What's up, everybody? Welcome to another episode of Swan Signal Live. I'm your host, Sam Callahan, Senior Analyst at Swan Bitcoin. Got another great episode lined up today with a recurring guest that I think everybody will enjoy. Before we get started, I want to bring up some of our sponsors of the show. The first one being Marathon. Marathon Digital Holdings is the largest and most technologically advanced publicly traded Bitcoin miner, as well as the most energy efficient. Marathon's primary mission is to enhance the Bitcoin network by sustainably increasing the amount of hash rate that helps make Bitcoin the world's most decentralized and secure monetary network. So go check out Marathon Digital Holdings, ticker MARA. Also, Pacific Bitcoin. Pacific Bitcoin is the festival that Swan puts on in beautiful Santa Monica. It's happening in October 18th and 19th. If you use the promo code SIGNAL, you'll get 10% off your tickets. And if you use Bitcoin, you get an additional 21% off. So 31% off if you go to pacificbitcoin.com. Check out some of the speakers we already have lined up, as well as the side events and workshops. It's going to be a really great time. So check it out, pacificbitcoin.com. And so, this show we're going to be talking about macro with one of the foremost macro experts. He writes a newsletter called The Informationist that breaks down the complexities of the traditional financial system in a way that anybody can understand. As well as he has interesting takes when it comes to Japan, as well as the kind of the more the plumbing of the traditional financial system. And that is my good friend, James Lavish. He's the managing partner at the Bitcoin Opportunity Fund, as well as I mentioned, the author of the newsletter, The Informationist. So welcome, James.
Thanks for having me, Sam. Great to be here.
Yeah, so it's great to see you. I think you've been on the show a couple times, maybe last year, but it's been a while. And everybody always loves listening to your takes on macro and kind of get a good overview of what's going on. But first, I want to talk about the last weekend you were in Las Vegas at the MicroStrategy Bitcoin for Corporations. It looked like a great time. So do you have any takeaways for any good conversations you saw, any good presentations you saw that you kind of walked away from and said, wow, this is really exciting?
Yeah, I mean, Michael's presentation on why Bitcoin is always it's a great 40 minutes or whatever, and yeah. He always brings up some extremely important points of from any angle you look at it, why Bitcoin is so important and why it's such an important, not just technology, but investment and asset class going forward, and ways that we can build on that. But the conference was, it was fantastic. It wasn't just the Bitcoin conference. It was actually the MicroStrategy conference. And we saw a bunch of salespeople, a bunch of clients there, a bunch of MicroStrategy clients. And, it's interesting to see that crossover and some of his employees coming over, some of the clients coming over, like guys from SAP or whatever. And they're really interested in what we're studying and what we're working on and why Bitcoin is so important. And so seeing that broaden out and having them understand why it's how it's becoming adopted institutionally is an important thing. You're starting to hear people accept that this is not going away. This is real. It has underlying value. It's being adopted and it's starting to be understood a little bit better. We have a long way to go, as you and I both know. We fight that battle every day, but it's encouraging. So,
yeah, it was kind of one of the biggest differences between this year and maybe the years prior was just some of the people from the institutions that were there, like the Fidelities as well as Citi. I think I saw somebody from Citi there. Mm-hmm. I think a lot of the ETF issuers were kind of prominent speaking on stage. And so you come from the world of Wall Street. I mean, what are some of your conversations like now with the approval of these ETFs? Has the sentiment shifted in your conversations just, behind closed doors? Do people agree that, hey, this thing's not going away? Or has the conversation shifted to more sophisticated questions about this new asset class, let's say?
I think it has shifted. And in the way it's shifted, Sam, is that the conversation has gone from the hard line from most of the Wall Street institutional investors that, Bitcoin doesn't have any underlying value, to, this is interesting. I can see why it's something interesting to trade. And so they're dipping their toe in it. But what's important about that is not that they understand it yet, because by and large, the people I talk to on Wall Street still don't understand it fully. And that's okay. It took me a long time too. there's a lot of mental resistance there when you're part of a system that benefits you so well that you're looking at something that's completely different. It's very difficult to get your head around. But that said, what's happening, and it's slow, the institutional adoption is happening, and you can see it in the ETFs. The ETFs make it super simple to buy these things and to buy Bitcoin, because prior to this, you really couldn't. If you were an institution, it was very difficult to buy Bitcoin. And the reason for that is just it was operational difficulties. It was career risk, it was personal risk for people, for investors and portfolio managers to stick their head out, stick their neck out and say, I'll buy some of this, I'll take the risk, and I'll hold the keys or what. It was very difficult for them. And then you'd have to have a lot of approvals internally to get to the point where you could actually do that. Whereas now with the ETFs, it makes it very simple. You can buy it with the same broker on the same exchange that you normally do. That's regulated. It's not an unregulated exchange. You can settle it with the same prime broker as you always do. You don't have to have a different prime broker. You have it custodied with that prime broker, and you DTC it, so it's all settled and held and in the same way as a regular investment. And it's marked the same way on the New York Stock Exchange time. It's so these questions are all settled, they're answered, and it makes it super simple. You just buy it just like any other stock. There's no margin on them right now, as we've come to learn, but it's the same exact thing. So it's kind of that risk of sticking your neck out and buying it early is shifting now. And so what you're seeing is people say, well, wait, what about this thing? And it's forcing them to do a little bit of work on it. And it's very easy for them to just go and get a small position. And we call that legging in. You leg into the trade, you get a small position, and it forces you. You say, well, it's in my portfolio now. Every day you pull up your portfolio, it's right there. It's staring you in the face. You don't have a choice, but you've got to look at it and say, do I want to add to this or take it off? Because right now it's just an annoyance. It's a 0.5% position. I got to do something with it. And so that's kind of where we're at, where you've got a few institutions. A lot of hedge funds are trading it. You've got a few institutions that are starting to get in there. But really, Sam, what I think is going to be the big catalyst is now we're bumping up against that period where the institutions that have bought the ETFs, they have to publicly disclose that. And we're going to start seeing some institutions publicly disclose it. And it's not because, and when they disclose it, that's not going to be like, oh, wow, look, the Cleveland Fireman Fund owns some Bitcoin. That's what it means is, oh, look at all of these institutions and these professional investors that have bought this thing. It's kind of turning where I better do my work on this, because now I'm getting behind. They all own this thing. I don't even know what it is. It's so that risk of buying it has flipped to the risk of not buying it. We're still in the stage, as you know, that people consider this thing in Wall Street and typically across the nation, they consider this thing a risk on asset. And it's going to take a while to change that. But this is the beginning of that. And that's what's really important about it.
Yeah, you're starting to see those filings start to trickle in. And there's a big one. Just they start to get a little bit bigger and bigger, it seems. We just had, was it Susquehanna? Is that how you pronounce it? $438 billion asset manager. They just exploded over $1 billion ETF position there. And you start to see like smaller ones, but you're starting to see bigger ones. And I think it's going to just continue to gain momentum. And we're going to continue to see it. I was wondering if we could talk about that DTCC news a little bit. Is that a big deal or not? A lot of people were kind of debating like, oh, it's kind of overblown. Bitcoiners are freaking out again. DTCC basically implemented new changes to the collateral. They basically issue no collateral value to any Bitcoin ETF, giving it a 100% haircut. So what does that mean, or what are some of the implications of that? And is that a big deal or no?
No, I mean, okay. When we own some of the ETFs to work around in our hedge fund, and we own it with our prime broker, and we have it's 100% haircut, and I expected that. And what that means is we can't margin it. It means that I can't buy it and then use it as collateral to go buy something else with, borrow against it. it's not really surprising. It's a super volatile security. It's typical of, for instance, what you'll see typically is in microcap stocks. For instance, if you own a microcap stock and you want to margin against it, you're getting a big haircut. And so you're getting that haircut because of the volatility typically, and the prime broker is they're concerned that that volatility will impact your ability to maintain that margin. And so it's not surprising. But the funny thing about Bitcoin and what people are missing with this is, and what's so important about this is, Bitcoin is a super, super volatile security. These ETFs are super volatile because they follow Bitcoin. And that's actually a really interesting thing for investors, because if you have a long-term view on this, very long-term view on it, that volatility actually helps you. And the way it helps you is that you maintain a position in your portfolio with it. So let's say you maintain a 3% position. Well, if Bitcoin goes up 100%, you and all else being equal in your portfolio, and now you have a 6% position. So you've got to scale that back. So you sell some. Bitcoin goes volatile to the downside, and now it's less than a 3% position. Let's say it's a 2% position. Now you have to buy a little bit more. So you end up being able to trade around it just because you're rebalancing your portfolio constantly. You're constantly rebalancing it. And what that does is it provides opportunity for long-term investors, and it dampens the volatility in Bitcoin along the way, because you have these investors who are selling as it goes up and they're buying as it comes down. So
we'll probably see the volatility start to decline over time as and more hedge funds start to get into the space. And
well, I think more and more institutional investors, right? The hedge funds, because the hedge funds will whip it around, but I think, and they'll borrow against it, they'll short it. I mean, they'll do everything. But I think the institutions coming in and having those long-term positions, having that weighting that they want to balance and maintain their portfolio is important. But really, what's important is there being enough capital in the Bitcoin ecosystem, meaning these ETFs have have enough market value that these huge institutions can get in and out with tens or hundreds of millions of dollars without a blink. I mean, you've got to be able to move $1 billion. So you can move $1 billion of gold, no problem. You need to be able to do that in Bitcoin, and so you can do it, but it's not it's not as easy for sure. And so that is a concern for them, and that's why it's going to take a little while. We're going to see this trickle turn into a river, which will turn into, I'm not going to say a flood, but a steady state of inflows.
So it kind of improves the liquidity. That's one thing that I always say with Bitcoin and the other cryptocurrencies is that Bitcoin's liquidity, its daily trading volume, I think it's like over $40 billion a day or something like that. Whereas that's more than the next 30 cryptocurrencies combined if you take out stable coins. And so like when people like see market caps, they have to understand that doesn't take into account liquidity. And so it's so important for these large institutional investors to have liquidity to get in and out of positions and not have a significant slippage. And so it's just another example of how Bitcoin really separates itself from the rest of the pack, because in terms of liquidity, it's by far the leader. It's not even close. So I just wanted to bring up that point.
Yeah, absolutely. It's not even close. And even I have a friend who played hockey at Yale after me, Keith McCullough at Hedge Eye, and he even said, I don't know if it was on his morning show or something, I saw a clip on it. He even said, "Yeah, look, Bitcoin is not crypto."
Really, he said that.
People need to take notice of that. It's not crypto. And I didn't see the whole clip, but it's really important for people to start understanding that. And that is a mindset shift. And we're going to continue to see that. And it's gaining traction in viability in the space, and especially in the institutional space. And that will bring a lot of capital into it in a short period of time, I think, in the next few years. Really, really important.
That's the first time I've heard Keith say something like that. You know, sometimes I tuned into his work, and sometimes I got great guests there and have good conversations over at Hedge Eye. But he was traditionally pretty against Bitcoin, or he's just kind of like a trader. He kind of looks at vol and different things, but like that's the first time I heard him distinguish between Bitcoin and the rest of the cryptocurrency. That's interesting.
Yeah, I mean, we have different on that, but we see eye to eye on a lot of things about the economy and where we're going and how it all works. So
yeah, I like Keith. Keith's a fun guy. I wanted to talk about like money printing because you saw that clip from Jared Bernstein. I think it's from the Stephanie Kelton's film. He's the chair of the Council of Economic Advisors, literally directly advising President Biden. And in the clip, I mean, it was concerning. Like he basically fumbles over his words, ties himself into a pretzel, just trying to explain how the government like borrows money, prints money. I mean, he basically confused himself, it seemed like in the clip. And I saw that in the Informationist, you wrote a thread and maybe an issue of that, kind of explaining what money printing is. And so first off, what's your response from that clip? I have to ask you, and then maybe we could get into the specifics of money printing a little bit.
So, well, two things. I have heard that, and somebody put in the comments somewhere that it was from a few years back, and he was recovering from a stroke, and so that might be why he was fumbling over his words. And I don't know. I mean, I have not done the research. The thing is, well, if he's still in that position, he's answering these questions. Like maybe he should have taken time off. But I don't know. So I can't comment on that.
That's fair. That's important to note.
I can comment on is this is confusing stuff. I mean, this is really confusing. And you ask your average person on Wall Street, they have a general idea of how fractional banking works, how banks have reserves and they lend out money that kind of creates money. But the money printing that we're talking about printing money with QE basically in times of distress. And when you see a real fast expansion of the money supply. And what's really important about that is that that's what adds to inflation. We've seen it. We've seen that how it exacerbates inflation. That's what we're talking about here. And what's it is. I did write a whole thread about it, so I won't go through the whole thread here and waste everybody's time. You can read it. It's on my Twitter today. But the punchline is basically the Fed goes out and they commission banks as intermediaries to go and buy bonds in the market for them, both treasuries and mortgage-backed securities. And they'll go and do that. And then the Fed just kind of presses a button and enters reserves on their balance sheet to pay for them. So then they can pass that through. And it's just money entering the system that wasn't there prior. And so it expands the money supply. You can see the expansion of the balance sheet of the Fed and the expansion of the money supply kind of go lockstep. And then there's further on, and we didn't talk about inflation in this thread. It was just about the money printing, but you can see a delayed effect where inflation starts to hit after the expansion of the money supply. So that's what's so important to understand about it. And so they basically can just print money. And they've said this before. They've said it on 60 Minutes. They've said we print money. That's what we do. So we'll never default. Why won't we default? Because we print money. No sovereign that issues debt in its own currency would ever default. Why? Because they can just print money and buy their own bonds. Look at what Japan is doing. They're doing the exact same thing. They've been doing it for years. And so they're running into issues with it, but that is exactly what's happening. And so that's what we have ahead of us. So I think we have continued perpetual structural high inflation. And the reason we have that is because we must have liquidity in the Treasury markets. And that means that we must maintain liquidity across the economy and across the markets in order to maintain that liquidity in the Treasury markets, because we're not going to cut expenses. We're already spending more than we are legally bound to with mandatory expenses and with long-term contracts with the defense contractors, and then just the interest on our debt. Interest on our debt is $1.1 trillion right now.
Stupid.
It's ridiculous. Of course, they get some of that back because of internal holdings, but it's over $800 billion that we're spending each year on interest on the debt. And at the same time, we're spending roughly $4.1 trillion on mandatory expenses, Social Security, Medicare, Medicaid, unemployment. So just add those up, that's $5 trillion. When Sam, we took in $4.4 trillion of tax revenues, or that's what we're expected to take in this year. I mean, you don't have to be a math genius to see that that's not sustainable. Like, we have to do something. And so that's kind of where we're at. And that's why the money is printed to continue, because when we have these times of shock, we cannot have the Treasury market act dysfunctional. Like, it has to keep functioning with high liquidity. And that's why they enter the market and they buy the bonds in order to splash liquidity into the markets and make sure that the engine just keeps running.
Well, you brought up Japan, and they're kind of, you could kind of view them as the guinea pig for modern day central bank policy, in terms of they were one of the first to implement QE back in like 2001, I think, and like zero interest rate policy, and their debt to GDP has exploded, like number one in the world, I think over 260%. And you're right. It seems like finally, after 17 years, they're trying to raise that interest rate off that zero bound, and they're running into issues. And so maybe you could touch on the developments, what's happening there, and then why that's maybe important for the broader global economy.
Yeah. So Japan has run into some issues. They had a big bubble that burst back in the 90s, and what happened was they had a big housing bubble, and so then they ran into a period of massive deflation. And so what Japan has been doing is, through Abenomics, they've been instituting what's called yield curve control, and what they've been doing is buying their own treasuries, just like I'm talking about, printing yen, buying their own treasuries, and making sure that the interest rate stays low, meaning that the 10-year JGBs, they've been holding them under 0.5%. They were holding them down to about just above zero for years. And so, but in doing that, what happens, especially when you have what has gone on in the rest of the developed world, including Europe, the United States, and other areas? Well, when you see interest rates rise in other areas, then what happens internally in Japan is it becomes a very low cost of capital. So you can sell JGBs and for under 0.5% of interest, and then you sell those and you receive yen for that. You sell the yen and you buy the US dollar because you want to buy US treasuries and get a return for doing that. Now, if you want to return your money back into yen later, there's what's called interest rate parity, where you have to buy yen futures, and that kind of evens it out, but you end up still getting a return for that trade. And so, but that's what's happening, is the yen becomes the escape valve. It becomes the pressure valve, because the pressure builds up in that system where they're artificially manipulating the rates lower in Japan. And so when you have rates that are multiple percentage points higher here in the United States, then you will get that trade, and that trade just, and you have massive funds that have huge leverage positions in this. And so you see these massive swings lately. Well, what the Bank of Japan has done, and look, let's face it, the Bank of Japan has a problem, because they own over half the treasuries themselves. They own over 50% of all outstanding JGBs. That's just insanity. They're the largest buyer out there. Their debt to GDP is over 260%. This is just madness, okay? It's not the same here in the United States. Before people go and compare it to the United States and say, hey, we can be just like Japan, the answer is it's different, okay? Japan is a net exporter. We're a net importer. They've got a different demographic. They've got different banking regulations and laws. It's just a completely different world out there. But what I can say is it just can't go on forever. So, and it can't go on forever in Japan. And so what is happening is, one thing they have done well, Sam, is they have not tipped their hand to exactly what their strategy is. And so they'll enter the market and they will sell yen, or they will sell dollars and buy yen without telling the market that they're going to do that, and they don't give parameters out. So they keep people guessing. They keep these traders and these leveraged positions guessing. So what you've seen in the last few weeks is you've seen massive volatility in this extraordinarily liquid exchange rate. And the reason for that is that they're wiping out levered positions here and there. And I've heard of a few hedge funds that got blown up on some trades here. And
Jeez.
so, yeah, and so that's what's been happening, and we're watching that. So one of the things, though, is that people are very concerned. To answer your questions, how does it impact the rest of the world? And people are very concerned that it impacts the U.S. because it means that, well, how do they do that? How do they get dollars to sell in order to buy yen? How do they sell dollars to buy yen? They can't just manufacture dollars. We have the dollars. How are they going to get them? They can't just print dollars like we can. Well, Japan is the largest owner of U.S. treasuries in the world. Not the Bank of Japan, but Japan as a country. They own $1.1 trillion of U.S. treasuries. So people are very concerned that, oh God, as they keep doing this, they're literally playing chicken with the Fed, right? So they're saying, well, we're going to keep doing this, and we're hoping that the Fed has to relent and lower rates, and that takes pressure off the yen. It takes pressure off of that trade. That's what they're doing. They're hoping that happens, that they can wait it out. They can get through this period of this pressure. Well, we haven't done that. We keep talking about higher for longer, and every single time you see inflation rates come in higher, then you see it pressure the yen because of this, right? Because this trade's going to keep going. So people are concerned that they're going to sell the treasuries to do this, and that is a valid concern. I believe, and we haven't seen it yet. That I have not seen any confirmation of it yet. But one of the things that's different about this world than way back when we had the Plaza Accord, and we convinced Japan and Germany to weaken the dollar by propping up their own currencies. What's different now is that we have these huge swap lines that are open. A swap line would allow Japan to borrow US dollars and basically sell them short. That's basically what we would do, is we would open swap lines instead of having pressure on the Treasury. Because remember, what did we say before? We can't have pressure on the Treasury. We can't have Japan with $1 trillion of treasuries competing with the Fed, the Treasury, the US Treasury, selling more bonds into the market. I mean, the Treasury has to cover a $2 trillion deficit. Like they can't be competing with both the Fed and Japan on this. So now, come full circle, you heard the Fed last meeting Powell said, okay, well, in June, even though we're not there yet, even though we're going to hold rates higher for longer, we're going to back off the QT program. But why would they do that if everything's going swimmingly? Well, it's not going swimmingly in the Treasury markets. We've seen a couple of troubled auctions that looked a little bit sketchy, and they know that. And so they know that they've got to start backing off. So what they're going to do is they're going to back off the QT that they've been doing, and they're going to back that off from 60 billion a month to 25 billion, which is a little bit even more than cutting it in half. And this is one of the reasons. These are all things that they're looking at to make sure that the Treasury market operates efficiently and smoothly, and that's why they're doing that.
We'll definitely get into those Treasury dynamics. I'm just curious. So it's basically they don't want to create a supply and demand imbalance here. If Japan has to be selling the bonds, where at the same time that the Treasury is issuing a ton of them to finance these deficits, at the same time the Fed would continue to let them run off. All that would potentially create supply and demand imbalances in the Treasury market. And so you're saying the Fed is now taking it back a little bit. They've stopped their runoff or decreased it by more than 50% to now 20,
next month.
25.
Next month is what we expect. Yep.
Next month. And has there been any instance so Japan has intervened, I think, twice. I think finally they officially admitted that they intervened. Do we know if they're getting the dollars from? Do they have like actual cash that they have on hand? Do they have to sell treasuries, or do we know that they'll probably get that from selling treasuries? Do we know that at all?
We don't know. I'm expecting we'll have to see if their treasury balances fall. It's difficult to know exactly what those look like, though, Sam, because of the way that they're reported market value. And so it's a little bit difficult to weed out what's fallen in market value versus what. So if our rates rise on the balance of their holdings, if the rates on the yields of the bonds that they're holding rise, well, that would be a fall in the market value. So that you have to weed that out. You have to separate that out.
Got it.
So that's one thing. What we have seen, though, we have seen this before. We've seen illiquidity in the markets a number of times before, but mainly the two big times that we've seen it, really big times that we've seen it, are in September of 2019, when the Treasury expanded the amount of treasuries that they were auctioning, and so they were asking the market for more liquidity than the market had, because they were running into tax payments in October. And so banks were low on their reserves, and they were holding reserves for tax payments. And then the next thing you know, they run into some really difficult, they ran into some illiquidity in the markets that spiked the repo market. So the repo market, where banks were looking for cash and they were laying off their treasuries in order to get cash. The opposite of what we've got right now, which is the reverse repo. The banks have flush with cash, and they're looking to get a return on that. But because of that, and then the second time was obviously in March of 2020, and then it happened again later on between 2020 and here. It's happened a couple of times where it got a little bit tight. But what the Fed and what Powell is concerned with, and what he said in not this presser, but the one before, was he said, look, we're watching the reverse repo, we're watching bank balances, and they're not a problem right now, but we're watching for that. And he has said before that when bank reserves get down around $2.5, $2.7 trillion, that's about the limit they want to see. They want to see reserves stay above that to feel confident that there's enough liquidity for these treasuries in the markets, and they're not going to run into another repo spike. Well, that's not going to be a problem until the reverse repo is drained. Reverse repo is about $400 billion now, and it's decreasing. It got a bump up a little bit from the last month, but we're going to see where it ends up at the end of this month. But it's getting down there. And so once that's gone, and once the bank reserves are down at under $3 trillion, well, I would expect that the Fed is going to call it quits on QT. They're going to just back away and say, okay, we're going to allow this to function normally, or they'll back it off to just a marginal amount, just to say that they're still doing it, $5 or $10 billion a month. And their contention is, by doing that, rather than just stopping altogether or maintaining until they have to stop altogether, it allows them a little bit more runway to peel them off longer term. So,
got it. And so, how would you say the liquidity has been in these treasury auctions? For instance, I mean, that's one way to kind of look at the functioning of the treasury market. People look at the move index is another thing people look at in terms of the volatility of the treasury market as a kind of like a proxy for liquidity. So how would you say things are right now, if you had to say?
Well, we've had some problematic ones. We had a 30-year treasury auction back in November that was very dicey. We had a 10-year treasury just last month that was not good. We've seen a few here and there, and they're just kind of dark spots on the treasury auction cycle, where you're wondering, well, where were the buyers? Like, what happened here? Why was this auction not so good? Well, today we had a 10-year auction that looked pretty good. I mean, just looking at the figures here, was it great? No, but just to give you an idea, the last 10-year auction last month, we only had about 62% of indirect bidders, which is those are the foreign bidders, and 14% of direct bidders, which are in their domestic bidders. And then the primary dealers, the ones who are out there, the banks, the Citigroups and the JP Morgans and the Wells Fargos of the world, they were stuck with 24% of these. Stuck 24% as a primary dealer of a major issue is like, that was just abysmal. And then they had a 3.1 basis point tail. And so to have a three basis point tail this is the reserve asset of the world. Like, this is the benchmark treasury of the world. And to have a 3 basis point tail was eye-opening. And what that means is that the auction went poorly compared to expectations, because the tail is the difference of what the yield that the treasury had to pay the auction versus where the yield was in the pre-market, because these things trade pre-market and a when issued market. It was 3 basis points, which over the course of 10 years is a lot of money. And so that was not very good. Today it went better. Was it great? I would have marked that one as like a D. That was bad. Was it catastrophic? No, but it was bad. Today we had another 10-year auction, and it was a big one. It was a $42 billion auction. Okay, so what were the numbers? Well, the indirect bidders took in 66%. The direct bidders took in about 19%, and the primaries were left with 16%, give or take a 0.5% here and there. So, and there was basically 1 basis point tail. Not great, but why was it so good? Well, there's speculation that a lot of it was short covering. So there were plenty of traders who were short these treasuries coming into today, and they used this auction to cover those. And so that's why it was tempered to the downside. So I'm watching these things though, and that's where my eyes are, and I'm paying attention to that, because if you want to know what's going on in the economy in the world, just watch the bond market. That'll give you the keys. That'll give you the signal probably first.
It just seems like this crazy game they're playing, the Treasury and the banks, in terms of just like, how do we get people to buy this paper? We got to issue all of them. There's like different like valves they could turn, in terms of the banks, and like the ISDA just had that like rule that they're trying to change and things like that. And it's just like all about like, how do we get people to buy our paper? And like one of the things I saw recently was the Treasury's doing buybacks, which I don't fully like understand it exactly. I was wondering if you could maybe explain it, but it just seems to me that's another example of like, hey, we're issuing them and actually we're just going to buy them back to help kind of with the supply and demand dynamics. But is that the wrong way to think about it?
No, I mean, okay, this is the way I see it. Is it's not a ton of liquidity, that we're talking about. It's not nothing. It's billions a week is from what they're talking about, but it hasn't started yet. And really what it is when I first started on Wall Street, I went up to one of the first desks I visited was the bond desk. And it was actually a mortgage backed desk. And I can't remember which firm it was. It was a big one though. It was the equivalent of a Citibank. And I go up to these huge guys, they're old football players, and they on their desks, they had these reams of paper. You're too young. You haven't never seen this. You might have seen it in movies though, Sam, is that they had these printers that dot matrix. They actually had little holes and wheels that wheeled out the paper. So when you got the paper, it had this, they had 2 perforated edges with holes in it that you have to peel off. Well, they didn't peel them off. They just left them on. Their bond traders. And so they had these stacks of these runs of
they'd be all attached together like an accordion or something. Like
Exactly. And so it was like an accordion that could stretch all the way across the room. But the reason they had that was that, because they didn't have laser printers back then, man. They were dot matrix. And so, but the reason they had that was that then they would pass it around the desk, is because we didn't have electronic quotes. It was a super inefficient market. And we did everything by the phone. And so they'd pick up the phone. Somebody wanted to trade a bond. They'd look they would look on the run. They'd say, well, where is it? Okay, this is where it's priced. This is what I can offer it to you at. Okay. And that was something that's on the run. If it wasn't on that run, it was like, I have no idea where to price this thing. This thing's so illiquid, it doesn't even trade. It's not even on my run. So that's called off the run. And those off the run bonds are illiquid. Okay, so that's what they're talking about. They're talking about buying the off the run bonds. Why? Okay. Because they're illiquid. They don't move. So if the Treasury goes in there and buys those, that just it's like to me, it's more like greasing the wheels rather than actual QE or putting in more leverage of like, having a wheel for more leverage. It's just greasing the wheels a little bit just to make sure it runs smoothly, but it's not actually like really inserting a bunch of liquidity. It's just, is it a sneaky way? A little bit. It's not QE, but it's not QE.
This is like 2019 all over again.
I think I saw
QE, not QE.
tweet that. Concoda tweeted that it's not QE, but it's not QE. I hope that makes sense. And I think it's kind of right. I mean, it's like,
it's a little different mechanism.
Yeah.
Okay, that's helpful actually. And so they started doing that. I don't know if you saw. I guess like around Japan and like, let's say they can kind of figure out a way to fix the supply and demand dynamics. It still seems like there's like a huge problem over there, and that the currency is just in decline. And you said that the currency is the relief valve there. Mm-hmm. And I don't know if you saw this clip from Ray Dalio, but he kind of shared the major indicators before a coming currency collapse. And he was just talking more broadly, not about Japan specifically, but he mentioned that you need a massive amount of debt. So with Japan, that's check. The central bank buying that debt, check. And then a currency in decline, check, all at the same time. And that's a prerequisite, that cocktail for a coming currency collapse.
Yeah.
And obviously, like, people have been talking about this forever with Japan. But like, so where does this end? Like, it's hard for me to understand, like, how the currency, like, who's going to buy Japanese debt? What even is the right interest rate for when the debt is that high? I mean, it's like insane to me. Like, if they just let the free market do its thing, it would just completely blow up.
Yeah. Well, don't forget, Sam, that back in, I want to say it was in the fall of 2020. We still had somewhere between 15 and 17 trillion dollars of negative yielding debt in Europe.
Yeah.
Negative yielding debt. That means if you bought a bond for 100 cents on the dollar, you got 97 or 98 cents back. I mean, it's just insanity. And so, but why did they do that? Well, because pension funds out there had no choice. They had to buy them. Like, they were just, it's in their rules, and it's in their mandates that they have to buy these things. It's the same thing out in Japan. You have buyers of it. The biggest buyer is the Bank of Japan, and this can continue for a long time. But what we have seen in periods in declining, and you typically see it in Latin American countries, where you'll see an onset of hyperinflation. It's hard to imagine a G7 hyperinflating. Could it happen? Absolutely. It's mathematical. It could happen. One thing they could do, though, is they can continue to use deficits to create productivity on their mainland. And the way they could do that is becoming energy independent. One way to do that is to continue creating nuclear power with those deficits. That would help, but they have to import their energy for the most part now. And so, but that would help perpetuate it. Is it going to solve it? Not right now, unless they have some sort of productivity miracle. I don't see it. But I'm concerned about Japan. We've been talking about it now for almost 2 years and watching it get worse and worse incrementally. Again, they're playing chicken with the Fed. I think if we do have what we're talking about here, Sam, it's kind of two paths. If we have what we're talking about here, where we get into a period of higher inflation, and Luke Groman talks about this, where you're just going to have a period of higher inflation. There's just no way around it. You have to have negative real rates. You must have inflation that's higher than the rate of return you're getting on your bonds. And if we do, as we enter periods of higher inflation, but if that drags those rates up, and it continues to put pressure on Japanese bonds and yen, well, that's not a good thing for them. That if we do that for the next 10 years, that would be extremely problematic for Japan. I believe that could be catastrophic for them. If we somehow get some sort of productivity miracle here, whether through AI or whatever else could happen, and we kind of skate through this without having to have massive inflation and really high interest rates, then that would alleviate some pressure out there. So it's really difficult to say how long this can go on for, but I believe it will continue to go on for a while. How long? I don't know. But how does it end? Badly. That's how it ends, badly. And sad to say, I mean, I have friends out in Japan, and I'm it's frustrating to see how massively these central banks have manipulated the system, and it's not working.
Yeah, I was just thinking about how crazy it was that, you said Abenomics, that guy was assassinated a couple of years ago. I totally forgot about that. But he's kind of the one who kind of led Japan down this road, and obviously, and it's just insane to me that he was assassinated, because you don't really see prime ministers or central bankers assassinated like that. But I was wondering if we could maybe, you saw some news coming out of Japan that like MetaPlanet is a company that kind of adopted a Bitcoin corporate strategy, and there's a little bit of hope for Japan that Bitcoin exists if somebody wanted to protect themselves against a coming currency debasement or something like that happening. What's your view on Bitcoin, just looking at the macro picture now, like maybe in the next year or so? It seems like we're in this holding period. We're kind of range bound, jumping around like 65, basically a little under 60, 65. We're just kind of chopping for months now, it seems like. So what's your view on Bitcoin in terms of the price? And then I would love to hear your just thoughts in general about the ecosystem, given your position at the Bitcoin Opportunity Fund, kind of what you're seeing is exciting, what's being built that excites you and things like that.
Well, like I said, the Bitcoin has this has been a very positive development with the ETFs being approved, the spot Bitcoin ETFs being approved, and for institutional investors to begin to buy this thing without having all the operational issues that they had prior to this. Really important development. There was not a flood of capital I expected more capital to come in quicker. But the reality is that these institutions they're taking a long time to get their heads around this and to understand it and to get the regulations internally around it. They're going through their period right now, that 90 to 100 day period. They're just tripping that mark where they're getting comfort with it. That quiet period is kind of over. They see that the custody is working, whether through Fidelity or through Coinbase, that BlackRock and the other issuers of these ETFs are maintaining strong correlation to the underlying. It's very little slippage there, and so those have been really positive developments. A lot of capital has come into the space in these ETFs. And so that's really important. Going forward, Bitcoin, we must recognize, like we said before early on the show, is that Bitcoin is still looked at and seen as a risk-on asset. It will continue like that until it doesn't, until there's enough capital in the space, and until there's really enough understanding in the space about it, and institutional investors really understanding what it is and why they should hold it in their portfolio in a separate allocation. That's paramount for this asset to grow beyond where it is now. It has to get out of that risk on asset mindset. It will eventually, in my opinion. It's going to continue. It's going to take more capital and continued growth and understanding across all of these different types of investors. And so what I believe is that over the course of this year and next, we're going to see a lot of institutional investors get their head around this and start establishing 1%, 2%, 3% positions in Bitcoin using these ETFs. And some of them will, especially family offices and smaller and hedge funds, and perhaps smaller institutions, will get their own ability to buy Bitcoin without having to use the ETFs, which will just expand on that. And that will mean that they're getting great comfort in it and understanding around it, and getting comfortable with the risk of actually owning it themselves. So But I think that that's going to continue. And so we're going to see this kind of trickle right now of institutions. We're going to turn that's going to turn into a kind of a stream and a flow, and then a steady flow. And just like a steady flow of a river of money that's coming into the space as these institutions get their head around it. Because like I said, they're going to take a 0.5% to 1% position. They'll stare at it on their sheets every single day until they decide whether they want to sell it completely or make it a full position of 2, 3, 4%. And that's where kind of we're headed. And so if you think about it in those terms, just go back to first principles. That just means that more money is coming into the space, that Bitcoin's price should rise accordingly. And to whatever multiplier you want to put on it, we've all talked about multipliers, but whatever you want to put on it because of the liquidity that's there now, I do believe that Bitcoin is going to crest the six-figure mark. It's going to be over $100,000 at some point later this year. That's my belief. The only caveat to that is if we do run into a hard downturn economically here, which I believe is a distinct possibility. It's a distinct possibility that we have some sort of event here where you have a washout of some sort of financial or perhaps an insurance or something institution that wipes out and takes down a number of institutions with it, or threatens to in an act of contagion. And in that case, I see us having a kind of a steep drop off and then a V recovery, because again, go back to the other first principle is the Treasury market must stay liquid, and they will print to make sure it does. So if it does dip down from here and we have a sharp drawdown, I believe that would be a buying opportunity, because I do believe that the Fed and the Treasury will come back to the rescue and print more money, and they'll print more than they ever have before in multiples of it, because they have to keep this thing liquid. So that's the only caveat. That's the only question. And how long that takes, when that happens, anybody's guess. And I do believe there will be volatility in Bitcoin, but I believe that volatility will continue on the upside. And that's why I'm so excited about the opportunities ahead.
Yeah, I mean, it just reminded me of, I feel like people forget about Credit Suisse, being a globally systemically important bank, basically being on the brink of collapse. And then there's like a shotgun acquisition on a Sunday. It's like they'll do anything to kind of keep the system alive. And because that was like a potential contagion event, right? If something like that of that size went down, I mean, the contagion would have been really, really big.
Would have been catastrophic. Yeah.
Yeah. So they'll come in and save the day, I think. But you're right. It could be very volatile. And in a sell-off situation, I don't think Bitcoin will be like shooting to the moon while everything else is falling. I don't think that's realistic. But I do think they'll come in and try to save the system. And then the ETF, I think I agree completely, because you've seen like Fidelity, BlackRock, and I think the fellows over at Bitwise have all said the same thing, which is that the first wave of this buying was retail, primarily retail, which had me really bullish, because I'm like, the institutional wave that everyone talks about, it hasn't even really happened, according to these issuers themselves. And so I think you're right. I think it's just going to take time for them to see these things traded, do the due diligence on them, and then finally pull the trigger. And then, like you said, maybe increase to a real allocation later down the road. So I think we're just in the early innings of that. But the pipelines are there. They're there, ready to go. And if they want to make that decision, I think it's going to be really exciting for the next couple of years. As we know, like Bitcoin is a very unique value proposition. And I think they're going to get their heads around it. But what about like the Bitcoin Opportunity Fund? Just real quick, like what kind of like building are you seeing that's exciting you outside the price action of Bitcoin itself? I know you and David Foley kind of work together on that fund and are always looking for opportunities. So anything interesting that you're seeing on the ground floor?
Yeah, I mean, we're investing in a bunch of different things that are super interesting. People think about Bitcoin, think about mining. Of course, we've got Bitcoin mining, but we also own companies that are into like Anchor Watch, that are into and they're creating the ability to have insurance around your Bitcoin holdings, and a really sophisticated hierarchy system for multi-sig protection on your Bitcoin holdings and your keys. And so that's one of the things that we're excited about. We we just made investment in this company Epic, and they're developing some great technology around chipsets and mining. And we're super excited about that. There's as we go and we see more and more financial companies that are looking to solve problems that arise from people holding Bitcoin and wanting to do things around it. Those are interesting things to us. And so we're seeing a ton of opportunity in the space. And I think that this opportunity is only going to grow as this ecosystem grows with the value of Bitcoin. So we remain extremely optimistic and excited about the space.
Nice. Well, great. People are interested. I think they have to be a accredited investor, and for anything with the Bitcoin Opportunity Fund, I should probably say that. But if you're interested in learning more, you could go check out their website. And then James, I recommend your newsletter to everybody, but The Informationist is the name of it for all the listeners who don't know. Like I said, he does a great job of breaking things down simply so that anybody could understand some of these nuanced topics that we touched on today. Nobody does it better in writing than James at The Informationist. So check it out. And James, just like, where can people just find your day-to-day thoughts, analysis? Like, what's your Twitter handle? What's your X handle, I guess?
Well, I appreciate that, Sam. Thank you very much. I do work hard on that newsletter. My Twitter handle is right there at James Lavish. And I'm active on Twitter, and my newsletter is right there. It's on the link in my bio there, but you can just go to jameslavish.com and sign up. There's a free version for it. It's super easy, and you get it weekly. And I look forward to speaking to you next time. It's always a good conversation with you. You have great, insightful questions, and I look forward to it. So
yeah, thanks, James. Appreciate it. And thanks for coming back on the show. We're gonna have you back on when anything happens with Japan or the bond market. You're always the first call. So have you back on soon, okay, my friend?
Awesome. Thanks for having me.
All right. Well, like I said, always a pleasure to talk to Mr. Lavish. James is such an expert with some of the stuff, and he's such a wealth of experience and knowledge looking at these markets. And we're just really grateful that he can share those insights with us and our listeners. So I hope you enjoyed it. Go check out The Informationist. If you haven't, go follow James. It's such a great follow on X. And thanks for listening to the show. Let me know what you thought. Subscribe to the YouTube channel. That always helps us get our message out to a broader audience. So every subscription counts. Like it, comment, let me know what you thought. Next week, we're going to get into some of these regulatory developments that have occurred recently with the Samurai Wallet, Tornado Cash. We're going to bring on some lawyers. And so going to be talking all about that stuff. So if you want to learn more about it, make sure you tune in next week for that show. And that's it for this week. Thank you so much for listening, everybody. Really appreciate it. And again, check out Pacific Bitcoin at pacificbitcoin.com for the festival in October. You can get tickets off by using the promo code Signal, 10% off. So thank you, everybody. I am out.